When somebody asks you what's a treasury company, well, a treasury company is a corporation that's capitalized on digital capital that issues securities against the underlying digital capital. Why is it it is a new class of finance company, a new type of company. There's insurance companies, there's banks, there are fund companies, there's finance companies, there are REIT, real estate development companies. There's plenty of types of companies and there's operating companies. Why is a treasury company new and different? It's because the Investment Company Act of 1940 prohibited publicly traded companies from capitalizing or leveraging on securities portfolios. That's why there's never been a Mag 7 treasury company, there's never been an S&P treasury company. You can leverage and you can 100%, this is why Warren Buffett has to sell Apple stock. This is why the Berkshire Hathaway portfolio of securities stays below 40% of its liquid assets. That's why he has so much treasury bills. The Investment Company Act created a carve-out for sovereign debt of the United States government. And so even though those are technically securities, they're deemed to be not securities or commodities for the purposes of the SEC 40 Act. That being the case, for any of these strategies to work, you have to go to 100% or more leverage. If you're only holding 10% of something, it's not enough exposure to make it a type of company. So the treasury company was born with the arrival of digital commodities, and specifically Bitcoin, the digital scarcity. You could lever a public company on gold, but gold is not exciting enough. 99% of investors don't think gold is a good long-term asset. It kind of tries to keep up with the S&P, but as a practical matter, to break through a new thing, it needs to be an order of magnitude better. And so because Bitcoin has been able to outperform the S&P by 3 or 4x, it's enough better that you could justify taking the risk on a brand new revolutionary thing. So what you see is now the rise of 180 public companies capitalized on Bitcoin. You also see an explosion of digital asset treasury companies based on Ethereum and Solana. Why? Because they're de facto being deemed commodities by the current administration. So they have de facto commodity status. If any other token were deemed a security, you couldn't pursue this strategy. That means all told, you got about 250 companies that are digital asset treasuries. And and you would say, well, can I do it with gold? Not really. Gold's too slow, too boring. Real estate, you've got REITs, but real estate underperforms the S&P. Soybeans, oil, people tried all sorts of things, but at the end of the day, if you've got a digital commodity which outperforms the S&P, you have enough performance to create a treasury company. Now the issue is, how will the industry develop? And we're in year 1 of this thing being birthed. And of course, 90% of the investors don't even believe it's a category. They don't even recognize it. 1% are enthusiastic about it. 2 or 3% are stumbling around. And with that as a preamble, I guess, Mark, what are your thoughts? What do you think is going to happen in this industry? And what are your opinions of treasury companies in general?
Well, I'm generally favorable of them. But as far as what I think is going to happen, I mean, we're trying to think into the future. And I think, unless you're Michael Saylor and you've studied the history of technology as well as read the fantasy books, it's hard for most of us to see the future. But when we have a new asset like Bitcoin, that's the digitization of capital, and it moves at the speed of capital, we have a new set of building blocks to build new things. And so we can kind of think about the financial system as we have today and then how this transforms it. And so we can kind of think about maybe what doesn't survive in the financial system and maybe what moves forward in the financial system. And so if you think about the $700 trillion sitting in the financial system that's earning somewhere between 0 to 8% right now today. But we can take this digitization of capital and then we can slice it up, as Saylor showed us, with different types of preferreds and different types of instruments that can provide something. As he said, typically treasuries have sat in that spot. We have 250 million people in the developed world right now, retirees, depending on some source of income. Again, $700 trillion of capital sitting on that income. And it needs better income, better yield, something safer than bonds. And so this new asset, this new digital asset that moves faster, that gives us this better CAGR, that gives us that room to then leverage into the S&P 500 and leverage into the debt and credit markets, it allows us to do these things. So I think some of the types of new financial institutions that we see kind of getting built on top of this are sort of interesting. Like obviously we're still going to have creators creating more than they consume, and there's going to need to be savings. So there's going to be financial institutions that will handle security, that will handle custody and things like that. I think we'll always have a need for credit. So we'll have financial institutions that are still providing credit. People are still going to need to buy houses. They're still going to buy cars. We're still entrepreneurs that need capital for businesses as well as scaling businesses. It'll be, as Mises would call it, commodity credit versus circulating credit. We'll be issuing credit off of savings. It's not just conjuring out of thin air. I think insurance is going to be a very interesting financial model into the future, specifically with Bitcoin. Warren Buffett showed us the power of having a float with insurance companies. So imagine if you're good at adjusting risk. If you're good at writing risk, you get the power of the float, put that into a Bitcoin standard. I think that's pretty powerful. I think about liquidity. So Bitcoin is, of course, peer-to-peer electronic cash. And so like I could peer-to-peer electronic cash with any of you here, and that's great, but if you're Walmart with 10,000 stores globally doing $680 billion, peer-to-peer electronic cash isn't really working. So you're still going to need payment providers, you're still going to need to pay hundreds of thousands of employees, you need payroll companies, so a lot of financial institutions in that space. And then ultimately, the last category, I still see, I think, a lot of improvement. I think where these treasury companies move into this financial future is security. So we're still going to need, companies will still need to raise money, we'll still need to bundle the money, we'll still need price discovery in the markets and things like that. But the difference is that we've had, this equity security market for 430 years built on fiat. And I think it all just transitions over to Bitcoin, moves faster, it's stronger, more transparent. And so really what happens is the Wall Street, the financial institutions are still there, but the Wall Street scaffolding that we have today is mostly collapsed. Things move faster, more transparent, and on a Bitcoin standard.
Bitcoin is the protocol. And when I look at it, I think that's my risk. If you're a Bitcoin maximalist, that's your risk-free rate. And so I think it's like 29% a year for the next 20 years. That's if you want to buy the protocol. And if I want to invest in anything else, it's got to outperform that by a large margin. It's got to, it's got to be like 40% a year or 50% a year. And so the Bitcoin treasury companies create things. Security is an application on the protocol. IBIT is an application on the protocol. MSTR, STRC, they're $1 billion, $10 billion, $100 billion application of the protocol. They move. People kept waiting for it. Well, how do we get a circular economy and how do we get people to spend Bitcoin? Well, $3, $4, $5 billion a day trades in 6 hours in the layer 3, application like on MSTR, or $4 billion or $3 to $4 billion in IBIT trade every 6 hours. So those the protocol is being fed by the applications, and I think that'll continue, and people are going to invent them at a ferocious rate. I think for sure. There's the question of which will be the first bank that plugs in Bitcoin, what will be the first insurance company, the first reinsurance company, what happens when you plug this into a company like an Apple or a Microsoft or a tech company, what happens when a government prints its own currency to buy Bitcoin, all of these companies, what happens when a city does it or a state does it. The way you're early is you haven't had a city sell a bond to buy Bitcoin. You haven't had a state finance with Bitcoin. You haven't had a country do it yet. You've had a few companies and people. We have yet to get a positive article in the Wall Street Journal after 5 years. Like I'm going to declare success when we get one article that's positive. Like Bloomberg said some positive things. But we're still very early, and the next 10 years will be, again, it's like the gold rush, but imagine the petrochemical industry in 1870. And and you're looking at plexiglass today and nylon and polyester and the like and lycra, and what were they thinking in 1870? Right.
Some of the recurring themes today have been kind of staying in your lane, keeping it simple and transparent for your investors, but also maintaining that leverage. In the example you used, Michael, was Standard Oil was producing oil and had a runway before the car was invented, and that really spurred that next use case for the oil products. In your mind, what is that next use case going to look like that transforms the marketplace as we know it?
The initial use case is digital equity, right? Equity, levered equity on Bitcoin itself, and people are getting that. And Metaplanet just sold $1.4 billion of it last week, so that's kind of proof that there's a market there. The next use case is credit, and we saw convertible bond credit. That we became the largest convertible bond issuer in the world. And I would say after my last 20 deals or 20 credit deals, if I was giving advice to a Bitcoin treasury company, I would say you ought to sell an equity which is amplified Bitcoin, try to get to 2x Bitcoin, and you ought to sell a simple credit instrument like a preferred that's a treasury preferred stock, variable yield on top of a currency. Pay 400 basis points more than the Swiss franc risk-free rate, or pay 400 basis points more than the risk-free rate in Europe, or 400 basis points more than the JPY yen rate, or 400 basis points more than SOFR. Go do that. Strip the volatility, strip the duration, strip the delta out of the instrument, and just, if there's anything that equates to gasoline, kerosene, like pure, highly refined crude oil, the equivalent of kerosene in our industry, I think, is pure credit spread, no risk. Like just 500 basis points, no vol, no risk. It's like when I asked everybody who's got a bank account, everybody, do you want your bank account to pay you 10% interest? Everybody. So a perfect, it's not the only model. There's 1,000 models. And so I don't want you to think this is the only one, but like I would literally say to someone like a Metaplanet, sell Metaplanet as 2, 3, 4x Bitcoin, sell Meta Yield as 6% in yen. That can become a $1 trillion company, and you don't need any other idea, because you're just fixing the entire money market in that currency frame of reference. So I think if you want to be very simple, it's just extract the pure yield, throw away the credit risk and the volatility if you can pull it off. And that's the last thing I did after 5 years of doing other stuff. So I'm just kind of saying you can skip my like the negative of starting now is, oh, you're later than us. The positive of starting now is you get to skip my first 4 years of mistakes, and I just gave you the answer. If I could fast forward and do again, I'd be like, I'd skip everything. I would sell Stretch. I would keep the equity. And I would focus upon selling that treasury preferred stock to every insurance company, every credit investor, every retail investor, plug it into every bank.
As I've been trying to orange pill people and the family office I'm responsible for, I think one question that I find very hard to answer is, Stretch, Strike, they're all great, but in terms of payment of dividends, what about operating cash flows? How sustainable is it? Will the Bitcoin will need to be sold at some point? So how would you advise me to address that question bang on so that it's a no-brainer?
Yeah, I think the answer is the treasury company is sitting on a mountain of hard assets. In a rational market, it'll just sell the equity to pay the dividend. In an irrational market where the equity decouples from the Bitcoin fundamentals, you're going to sell the Bitcoin volatility, or you're going to engage in derivatives trading in order to extract the yield directly from the Bitcoin. If necessary, you're probably going to sell a future, right? You're going to sell an out-of-the-money call option against the Bitcoin, or you're going to enter into a basis trade. And in the worst case, you're just going to sell the underlying Bitcoin itself, because as long as Bitcoin is growing at a multiple of the underlying dividend, you always have that as a final option. By the way, the reason that you don't immediately go there is the most tax-efficient thing you can do is sell the equity. When you sell the equity, there's no tax. We could generate billions of dollars by selling derivatives on the Bitcoin. We generate a taxable event, and so we don't do it because it's just not as efficient, and it doesn't expand the capital structure of the company. But if somebody says, well, how are they going to pay the dividend? The answer is you're going to sell the equity. Well, if you can't sell the equity, then the answer is we're going to sell derivatives on the underlying Bitcoin itself. And that market has got there's $60 billion of liquidity in Bitcoin. So if you can't sell the Bitcoin derivatives, which is a very healthy market, you're going to sell the Bitcoin into the market.